Hello. Today I want to talk about international stocks. One of the things I've noticed is everybody is ignoring international stocks. Do you feel this way when you feel like you want to travel and you go over, maybe you go into Paris or maybe you go to the UK or maybe you go to Germany somewhere and it's really nice to visit, but there's a warm and fuzzy feeling that you feel when you come home back to the United States? Well, investors are feeling that same way about stocks, and they've been feeling that way for way, way too long. And I want to show some evidence of that by looking at a long term picture, just stepping back and looking at the last few business cycles and comparing the performance of US stocks as well as developed market stocks, which would be like mostly Europe, but countries that are more developed, and the performance of the emerging markets, which is primarily China. Obviously, there's a lot of other countries in there, but since China is the biggest market weight in there, it's mostly China. So if you look at this chart that I'm showing up on the screen and look at the top, that top chart shows the S&P 500, and the middle chart shows the emerging markets, that would be mostly China, and the bottom chart shows the developed markets, which would be mostly Europe. And these gray shaded areas shows when the recessions are occurring. So as you can see right now, over on the far right here, it's shaded gray, meaning that we're in a recession right now. So technically we're in a recession. But if you notice what's happened is this last correction that we saw was a massively fast correction and a massively fast rebound, one like we haven't seen in, I believe, ever in our US stock market. Unprecedented. It was funny. I was reading a book written by Edwards and McGee that was published in 1948. And one of the things the author said was, and this is again written a long time ago, he said, the primary trend and the secondary trend, meaning the longer term trends in the stock market, cannot be manipulated, because if they were manipulated, it would put way too much stress on the US Treasury. Well, the news flash here is that we have decided that we're going to actually put that stress on the U.S. Treasury, as we can tell by $1 trillion plus deficit spending, massive ballooning of debt, massive printing of money, and that's what's been driving this extremely fast rebound. Normally, markets do not act that way. This is something that we have not seen before, and we have seen lots of money printing before throughout world history, and it never ends well. But hopefully we'll be able to divert it. But there's a lot. That's a whole nother story. But what I want to talk about right now is what we could do right now and how you, as an investor, can maybe improve your performance. So let's take a look at the last few cycles. If you look at I'm going to go on to the next chart here. But before I do that, let me just point out a few things. You'll notice that in the last, this whole, after the big financial crisis, which is this bottom that we saw here, right? We had, several big moves up and some sideways movement. But if you go prior to that, the prior business cycle, okay, we're going way back, in the early 2000s. It actually took us 11 years from the peak that we saw in the dot-com bubble, 11 years before it actually made new highs in the S&P 500. So that was one of the longer bear market, secular bear markets we've seen. So that is something to keep in mind. Now, during that last one, you could tell, if you look in that last period of time when we weren't going anywhere here in the United States, we saw the developed markets really move up fast exponentially. You can see that exponential move higher. They broke out, international stocks broke out and did way, way, way better than stocks in the United States. And then since that time, in this current business cycle that we just finished, you can see that overall, international stocks in Europe have not been making any progress. They have not broken from the highs from the previous recession that we saw from the financial crisis. So that has led a lot of investors to believe that somehow it's just going to be way better for you to own US stocks, and that's going to stay forever. Well, as we could see, this does not happen from cycle to cycle, right? If you go to the cycle even prior to the last cycle, right? Going back after from 1990, so that was after Saddam Hussein war and all of that. You can see at that time the US was doing really, really well and international didn't do well. And what happened in the next cycle? We saw massive outperformance in both emerging markets and in developed markets outside the United States. Well, I would argue that we're in that scenario right now, right? It's a very similar scenario. And if you look at valuations right now, the United States stock market is trading at a much more expensive value. It's like something like 4.5 times the average when you look at the CAPE ratio, which is a valuation ratio that's very popular to use to look at the longer term valuations in the market. So whereas if you compare that to emerging markets and you compare that to international markets in the developed world, it's much, much more attractive. Even though they have had lower growth rates in the developed markets, from a value perspective, that's really been priced in. And if you look at the emerging markets, there's a lot of potential for future growth. So I'm going to go to this next chart here. And I think I need to actually stop sharing that for a second. And I'm going to go to share a different screen really fast. Share screen. I'm going to do application window right here. Okay, so you should be seeing this now, hopefully. Oh, wait, you're not seeing it yet. Oh, yeah, you are. Okay, so here we go. So in this chart, oh, the chart didn't change. Okay, I'm just going to tell you verbally, having a little bit of technical difficulties. So if you look at the outperformance, the next chart I was going to show you shows the relative performance relative to the S&P, and it's very pronounced. You can see these outperformance and underperformance of the various markets in the different cycles. And it really accentuates the fact that we are in a position where potentially the small cap stocks, the international stocks, both developed and emerging markets, are in a position where they could potentially do way better in the next business cycle. I'm talking long term here. So if you're an investor and you've been putting all your money in, which we see this a lot right now, we see this a lot. If you're putting all of your money into the U.S., consider paring back some of that U.S. and putting them into international stocks. So that's my message for today. I hope you guys are doing really well. Hope you are doing really well. And that's all for now. And I'm going to let you go. Take care. Bye.